Hi, I'm Lawrence Parker Brown. Welcome to the Inside Network. Joining us today to explore income, private credit, and the defensive side of portfolios, we're delighted to be joined by the head of asset management at Thinktank, David Dix. Thanks for your time, David.
Great to be here, Lawrence. Thank you.
So David, for a lot of advice groups, if they look at their portfolios, there's a feeling that the defensive side of the portfolio hasn't quite done its job. We're also experiencing a period where hybrids are about to exit the market. What are you hearing from different advice groups, researchers, and consultants about how they can potentially fill some of the gaps that are appearing?
I think the first thing I would say is that there's no question about the structural challenges that have existed in the defensive parts of client portfolios and more recently. And I think a couple of examples I would point to, in particular, 2022 was a very challenging year for advisors and clients. So we're talking really about kind of circa 10% falls in a duration fixed income portfolio, traditional bond style portfolio, came as a shock to a lot of people. And I think out of that, it started raising questions really. And I'll also point to the 10-year returns that we've seen more recently for those asset classes, which are hovering just around 1.5% on an annualized basis. I mean, I think for anyone, they would look at those types of returns and say that's certainly under cash and not really meeting my expectations. And then I've also got questions about, whether it's true to label when I need it to be true to label. So for me, that's really underpinned this question of, well, what should be sitting in my defensive part of the portfolio and how should it perform over time and what are my expectations and whether it will meet that. I don't think this is a recent phenomenon as well. Like you've actually seen advice sophistication building over many years. So if we look at the last 15 or so years, we've seen advisors get a lot closer to the portfolio and the construction of the portfolio, and some of that has been kind of underpinned by the emergence of asset consultants and SMAs. So advisors and advice tools are a lot more sophisticated. I'd even point to platforms providing more tools for advisors to be able to construct portfolios and deconstruct portfolios. So that's another kind of wave that's been emerging over some time, where you now have advisors being able to make decisions on their own behalf and be able to make changes to the portfolio when it's suitable. The third thing I'd say is that investors have changed over that period of time. So more recently, we've seen the baby boomers, that rump of the population move into the retirement and pension phase. And really, the main draw card for them is income. Yes, I need portfolio stability, but I also need to live. And so they need that income constantly coming through and income certainty. And the last thing I'd say around your point of the hybrid market closing, so it's essentially a $43 billion market that's basically going to shut up shop. And so that's led to a number of products coming to the market and offering solutions that can meet the needs of those income kind of orientated investors. So I think you bring all of that together, and I think that kind of is a kind of natural story of why there's this shift towards income solutions.
So filling that gap, David, some investors, some advised clients are looking towards private credit. But with that comes the noise that we see in market from regulators, from the media, and some market commentators. Now, thinking of your experience, David, 25 years of looking at multi-asset portfolios, coming into this space alone, what did you expect to experience and how is the reality different?
Yeah, it's true that majority of my experience has been with multi-asset managers, but we've certainly invested in private credit and income-based solutions. I guess the first thing I would say is the professionalism and sophistication that sits with this asset class, and I will call it an asset class because I think it is now. So if we talk about some of the numbers, in Australia, it's over $200 billion asset class, and we're seeing managers and products come to the market, and And we're also seeing, I guess, a sophistication coming into the types of solutions that are being offered in the Australian market. And that's really on the back of private credit existing for the past 30 or 40 years, particularly in the US, which represents about 60 to 70% of a $2.3 trillion market. So this isn't new by any means. I think private credit performs a really important role. And you mentioned before the hybrid market and how that's now coming to an end. So there are products which are now looking to come to the market to fill the void there. They're underpinned by very strong asset base. So again, if we look at the Australian market, many foreign fund managers, banks, insurance companies have been stepping into the Australian market for many years and investing in our residential mortgage-backed securities, our commercial mortgage-backed securities, our asset-backed securities. And so that in of itself is over $200 billion market. That's probably one of the things that I took away in joining the Thinktank and seeing the quality of this part of the market.
So David, you touched on Thinktank, 20-year track record of growth and success, but a reasonably new name to the wealth space. What's Thinktank bringing to the market that isn't currently available?
One of the things I think that drew me to the business was exactly as you point out, 20 years of history. In fact, it's our anniversary this year of 20 years. I think, again, back to the exceptional quality of the people in the organisation. If I just describe what Thinktank does, Thinktank is a lender, a non-bank lender. So it is highly regulated and in a highly regulated space. But essentially, we fulfill the demand that comes from the 22,000 mortgage brokers that sit out there on behalf of their clients. And as we know, around 80% of every loan that's settled in Australia is done through the mortgage broking community. So for us, it's a very, very important distribution channel. We have a number of white label aggregator relationships. That's part of the reason why Thinktank isn't exceptionally well known in the market, but it is very well known in the broker market. What we tend to do quite well is that we operate in quite small value loans. So if you're thinking about someone wanting to buy a house or a property, commercial, residential, could be an industrial site, they might go to their broker. That broker subsequently comes to Thinktank. Why they come to Thinktank is really we can settle the loan quite quickly. So we can do our credit checks quite quickly. You can settle the loan quite quickly and get the money out the door. We have a track record of being able to deal in complexity as well. Not every trust is straightforward. There's lots of, behind the scenes work we need to do around AML, KYC checks and compliance checks. But once you have an integrated system that you've done this for many, many years, speed, efficiency, quality of our credit checks, all of those things come together to underpin an organisation that does very well in its space where it sticks to its lane. So Thinktank has a very diverse asset base. So we have over 14,000 loans, an average LVR across the business of somewhere in between 65 and 70%. And the other thing I would say is that we have a very strong funding source. So we have many of those offshore insurance companies, fund managers, banks, etc., and domestic as well, investing in Thinktank-based solutions. So many of our RMBS, CMBS securitized solutions. In fact, last year we issued our first $1 billion deal. So we're a sizable player in that market. And for me, wrapping all of that up, Thinktank's done the hard work. And for me, I get to come in and perhaps ride off its coattails. But we're not as well known in the wealth space. And so that for me is kind of the blank canvas of taking all of those great bits and packaging that up into viable solutions. In fact, we have a couple of products that we've had for about 9 years. And again, the important thing is they've never not paid interest and never had a capital drawdown over that 9-year period. So for us, to me, it's a sign of quality.
That quality that an advisor wants to see is really important. They want to avoid some of the noise that comes with the space. What are the questions around the loan quality, the security, and the manager that sits behind it that can cut through that noise and give them confidence that they've got the real facts?
Yeah, I pointed out before, ASIC have done a good job in highlighting where some of the gaps exist in this market. And I think it's a great starting point, that report 820 that they issued last year. And it was biased, it was kind of tilted towards ensuring that fund managers, in particular private credit fund managers, spend and focus their time and energy on getting the governance right. But it also allows an advisor in a wealth business to be able to look at the areas that they need to be questioning as part of their due diligence. And I think the first area to to spend time on as the manager. And I talked about some of those important areas such as experience of the people, quality, tenure, the quality of the book, quality of credit and credit controls as well. Asking whether they've had, defaults in the past, and business has been around for many years, should have defaults, and they should be able to deal with those defaults. I don't think defaults are, we're taking risk at the end of the day, so they're part and parcel of a credit business. I think the second point I would raise is really around security. So ultimately, and I can give you an example of two assets. One is generating 9% return, to maybe 4 to 5% above the cash rate. It might be 300 loans, so good amount of diversity there as well, maybe 70% LVR. And you compare that to a single asset in perhaps construction and development, and that asset might be generating somewhere in the region of 12% versus, say, 9% for that diversified portfolio. So I can understand why investors would want the 12%, but they need to look at what underpins the security of that portfolio. And for me, it really kind of comes down to this question of what is the probability of default versus what is the loss given a default. And for advisors to ask those questions, they can start to get to the bottom of the assets, what they're investing in, the quality of the credit, and how much risk am I taking, and what I need to be rewarded there. The last thing I would point to is really around liquidity in this space. I think it's important. There are many vehicles that have come out more recently which tend to kind of say that they're solving the liquidity problem, so monthly or weekly, even weekly liquidity. The question that advisors need to be asking really is what is the asset base that's going to generate the liquidity for that client? How much turnover? Is it likely that we're going to be able to get the liquidity when we're asking for? And some recent events that have happened overseas have perhaps, I think, highlighted the reason to be asking these questions. So for me, they're probably kind of the three main areas that advisors could be focusing in on to ensure that they are, looking after their clients' best interests.
Drawing on that message, the portfolio construction piece is where I'd like to close this conversation out, David. Understanding where an advisor might want to position this type of asset, this type of loan. Does it, for example, have qualities a bit like infrastructure or listed property? And what sort of characteristics would give you confidence to place it in the portfolio in a specific place?
First thing I'll say is that I think it is becoming a core allocation. It perhaps isn't there for the bulk of the advice community. And there's probably some good reasons why it's not at the moment. But I think it's emerging as a core asset class. And you pointed out infrastructure, so listed infrastructure and listed REITs as well, as two areas that really over the past 15 to 20 years have become a permanent part of client portfolios. It's I would argue that most client portfolios now have probably a 3 to 5%, if not more, allocation to each of those asset classes. And the reason why advisors have become comfortable with those types of assets is that they've been able to deal with those asset classes over multiple economic cycles. And so they have some certainty of the types of outcomes, I guess the boundary of outcomes that they will deal with and expected to deal with, and then can appropriately size that in the portfolio. So private credit will continue to play a role in and a core role in client and advisors' portfolios, partly because of the question around the existing defensive assets that haven't maybe met expectations. But I think also that point around income certainty, and that will continue to be a key driver over many, many years. And from what I've seen to date, in this asset class over 6-7 years, is that it has been able to deliver income certainty and capital certainty as well. And so let's go through those multiple cycles. Let's see how it performs. And the jury is perhaps still out. But I think in my mind, it will certainly become a core part of client portfolios.
Over those cycles and years, let's continue the conversation and let's see how the evidence maps out. But I think you've given us some great insights. So thank you very much, David.
Great to be here. Thank you.